Now, the Fed doesn't control auto, mortgage, or credit card rates, but the Fed fund rate is still important. It still affects all of these different rates. Now, the Federal Reserve does not control the rate of your mortgage, the rate of your auto loan, or even your credit card rate. Yet the Fed fund rate is an anchor for all other type of interest rates. So in this video, we're going to discuss what the Fed fund rate is and how it affects these other major rates. So let's deep dive into this topic. Now, before we get started, let me just say that if you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this and hit that thumbs up button for me. The federal fund rate, or the Fed rate, is the rate that U.S. banks pay to one another when they borrow or when they loan money to one another. Now, banks need a certain amount of reserves and liquid money on hand in order to conduct everyday business, to make payments, to do all the stuff that they do. At times, and usually it's on a very short-term basis, they need to borrow an X amount of dollars in order to complete a given amount of transactions, and they will borrow from other lenders in order to conduct their business. Sometimes it's for a little bit longer amount of time, but sometimes it's for a very short amount of time in order for them to have a certain amount of reserves and just to do business. This is regular standard banking process. It literally happens all the time. If it did not happen and did not work this way, our entire financial system would not work the way that it does. In the financial industry, this is just a common practice. It kind of happens behind closed doors, without people knowing. And the Fed fund rate, that is the rate that the Federal Reserve sets for lenders to be able to do this type of practice, to borrow money from one another to cover their reserves and their payments. So the Federal Reserve doesn't set or control auto loans, mortgages, or credit card rates. Now, the Fed doesn't control auto, mortgage, or credit card rates, but the Fed fund rate is still important. It still affects all of these different rates. Now, lenders can choose to set whatever rates that they want to. Lenders that give you out your mortgage, your mortgage rate isn't going to be exactly what the Fed fund rate is, but there's another rate also called the prime rate, or some have heard it as the Wall Street prime rate and the US prime rate. The prime rate is another rate that's, very important in finances. It's usually 3% higher than the Fed fund rate. So for an example, the Fed fund rate at 5.5%, the prime rate will be at 8.5%. And lenders will use that prime rate as sort of like a benchmark for the rates that they set for all other things. Now, just as an example, you might apply for a credit card, get a credit card statement. You might see on the statement your rate is 12% plus prime, so plus the prime rate, and it will move. Credit card, those numbers especially, they will move more. So a mortgage, if it's a fixed rate, you're going to get that rate at the time, what was prime, what were current mortgage rates. And a fixed rate is different than a variable rate, but credit cards especially, you might get 12, 16 to, depending on what your credit rating is, but a lot of times it is plus prime, plus that prime rate, which is another rate that goes off of that Fed fund rate. So, and because I'm making this video because I've seen a lot of people, well, the Federal Reserve doesn't control mortgage rates, and mortgage rates don't mean that they're going to change when yes, it does. All of these lenders, they move their rates based off of what that Fed fund rate is, which is also based off of what the Fed fund rate, the prime rate is going to be based off of that. That prime rate is what lenders are going to go off of as a benchmark as they set their rates. This is just common practice in the financial sector. So while the Federal Reserve doesn't control your mortgage rates, when the Federal Reserve drops rates, you can expect for other rates to drop. It doesn't mean that they'll drop the same amount as the Fed dropped their rate, or and lenders don't have to drop rates. And different type of rates, like your auto loan and different things, they're going to move differently, riskier type of things. And it goes based off of your credit. What I get might not be what you get for a rate if one of us has a worse credit rating, and things of that nature. But The Fed fund rate, or the Federal Reserve rate, it is a rate specific to when banks borrow from one another. There is a prime rate that is typically 3% higher than that Fed fund rate. Lenders that give you credit cards, business loans, mortgage, all of that type of stuff, they go based off of that prime rate, which is also based off of the Fed fund rate. So while the Fed does not control all of our other interest rates, those rates are definitely affected by the Fed rate. If you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this and hit that thumbs up button for me.